pleasant day to you, economics learners, economics grade 12 learners. It's a good day to you. Welcome to yet another exciting experience, yet educative at the same time. We are meeting in a discussion in economics, paper 1 for grade 12. Most specifically, we are targeting to prepare you for the junior examinations. So we are having this sample paper that we are going to use in this discussion to guide you on how best you can respond to the paper 1 questions, and also try and elaborate on some specific aspects that might be needing a clarification in an effort to assist you to score the best. Right, without wasting much time, we move to our questions. Right, as usual, we are starting with our section A. Section A, which starts with multiple choice questions. Right, the first question is saying, the fuel used when traveling is seen as the fuel that you use when traveling. How do we classify it? We understand that fuel is a consumer good, but what kind of a good does fuel fall under? Fuel falls under non-durable goods. Right, in the sense that fuel is meant for final consumption and is meant to satisfy the direct needs and wants. Our need here is travel, which is addressed by using the fuel, and is used immediately, and it finishes immediately as it is being used. Right. The next question is saying, the dash of employees include all gross salaries and wages. When you're looking at salaries and wages, that is the compensation for the employees. When you're compensating them, we are paying them or remunerating them in their effort that they would have put in production. So that is a compensation of employees. Right. Number 113 says, a country's dash consists of its current stock of currency and the deposits its domestic private sector have in financial institutions. What kind of a description is that one? Basically, that looks at the country's money supply stock. The money supply stock consists of the current stocks of currency in circulation, and also the demand deposits that have been put into financial sectors by the financial institutions. That is the money supply, total money supply. Then number 114, it says the length of a business cycle can be measured from. When you're measuring the length of a cycle, basically you understand that a business cycle is something like that, and we have our level of GDP measured against time. So our cycle, we have, say, something like that, and going like that. So when we're looking at the length of the cycle, we can measure the length of our cycle from one trough to another trough. From here to here is a length of the cycle. Or also we can measure our length from one peak to another peak. Is also a length of the cycle. So in this instance, we are saying we can measure our length from one peak to another peak. Then number 115, it says, dash protect the low income earners from being overwhelmed by the burden of tax. What is protecting the low income earners in this instance, so that they are not burdened by the tax, the burden of the tax? In other words, you are saying what kind of a tax regime protects the low income earners. In this instance, our correct response qualifies to be a progressive tax system. For example, South Africa adopts a progressive tax system. What we are saying here is the higher you earn, with a progressive tax system, the higher you earn, the more you pay. That is progressive, which means the amount that is payable is increasing with the increase in the tax bracket. The more you qualify for a higher tax bracket, the more you are liable to pay a higher tax percentage. That is progressive. Then regressive is the opposite. The higher you earn, the less you pay. That is regressive. And also, if you look at value added, this is indirect tax, which is tax on consumption. And then proportional, it means the same amount. The same percentage is payable for all taxable income. So proportional, we are saying there is the same percentage which is payable for all taxable income. Regressive, the higher you earn, the less you pay. Progressive, the higher you earn, the more you pay. Right. So the one that protects the low income earner is the one which is progressive, because low income earners, they belong to the lower tax bracket, while it's high income earners, they qualify for a higher tax bracket. Right. We take it to the next question, which is number 1.16. Our question says, all taxes are paid by. All taxes are paid by. The all taxes that you have, they are paid by individuals. A dash category that act to contain items that do not fall into other categories. What do we relate to that when you're calculating national statistics? The residual category, the residual, right, number 118, it says, dash are expressed as a percentage that gives the value of a country's exports relative to the value of its imports. We are comparing relative export prices to relative import prices. That comparison is determined by the terms of trade. So our terms of trade, it gives us the value of exports as compared to the value of imports, to see if we have a negative terms of trade or a positive terms of trade, or our terms of trade are balanced. We compare what we export versus what we import in terms of relative values. Right. That is number 1.1. We move on to question number 1.2. 1.2, it says, it's a matching column question. The first one talks about fallacy of composition. I understand you know what fallacy of composition is. When I'm talking of a fallacy of composition, we are saying the behavior by one individual does not determine the behavior of the total. Meaning to say, if the behavior of one business, we can determine it, it does not mean that that business, if it's operating against other businesses in the economy, they will portray the same behavior. So if we look at it from here, we can safely say number 121, fallacy of composition, matches with C, which says generalizing their own experience as individuals when explaining the operation of the whole economy. How a person behaves as an individual is not the general behavior of the totality of all participants in the economy. That is fallacy of composition. Then extrapolation. I understand you know when we're talking about extrapolation, we are using non-facts to predict the future. We use what we already know to come out with a conclusion of what is going to happen in the future. So our item which matches that is F. F, which says estimate the unknown data based on a pattern of known data. Then appreciation. When we're talking about appreciation, we are looking at when the value of a currency increases in terms of another country's currency, which is E. When the South African rand appreciates, we are saying its relative value compared to other countries, it now has higher value compared to other currencies. Like if you are comparing the South African rand versus the US dollar, we tend to find that If, for example, in situation A, it was the South African rand, maybe we are saying South African rand 20 is equivalent to maybe US dollar $1. And then we see that in situation B, it is now South African 15 rand, which is equivalent to US $1. We have seen that the South African rand has appreciated. It has gained value compared to the US dollar. That is appreciation. Then we talk of economic rent, which is number 124. Our economic rent is described by income earned more than the minimum required to keep a factor of production employed. That is our economic rent. Our economic rent mainly is payable for factors of production which are scarce. And for the sake of them being scarce, it means the rent that is supposed to pay it for those factors is higher than the minimum, which is just required to keep a factor of production in its current line of production. So economic rent, it matches with item A. Then we look at autonomous consumption, which is number 125. Autonomous consumption, ultimately, it matches with item H. Our item H says the amount of money spent by a consumer even when they have no income. Right, we are looking at that kind of expenditure, which is not optional. Autonomous, it means you are supposed to spend even though you don't have income. But we also have the opposite, because our two types of consumption, when we are looking at it from the economics perspective, we have autonomous and also have induced expenditure. So induced is that kind of expenditure which is determined by the level of income. The more you have, the more you consume. The higher the income level, the higher the consumption. But with autonomous, you are saying it is independent of the level of income. Even if you have zero income, you have to spend. That is autonomous expenditure. Right, we look at globalization. We understand the concept of globalization. We are saying we are now in one global village due to increased transportations and communications across the world. We are now able to interact with people across the world and do business with people across the world in the shortest possible time. Right, so our globalization, we are looking at it from the perspective of I. Our I says the process of increased international cooperation and communication leading to increasing trade and international business transactions. That is the one which matches with globalization. Let's look at the national treasury. When we are looking at the national treasury, we are saying those ones are the ones who are responsible for managing the affairs of the economic affairs of the country. And in this instance, managing the country's economic policy, which is B. The treasury manages the country's economic policy. Then you look at it, number 128, it says contractionary fiscal policy. Right, we understand we have fiscal policy as a government policy which determines our fiscal policy as a government policy. It entails of two instruments, which are number one, government spending, and taxation. Those are the two instruments of monetary policy. So they are manipulated in such a way that they help in achieving the desired economic goal. For example, the economy is overheating, we want to contract the economy. If you are adopting a contractionary fiscal policy, it means we can reduce government spending and we increase the level of taxation, such that we dampen demand in the economy. Or if you want to adopt an expansionary fiscal policy, we do the opposite. We increase government spending and we reduce our taxation. So when you're looking at a contractionary policy, the matching item to contractionary policy is item G. Government decrease spending and increase taxation. That is what we do when we are adopting a contractionary fiscal policy. Right, that takes us to the end of question 1.2. We move on to question 1.3. which requires us to give an economic word or a term. Right. The first one is saying a payment made by government to its citizens without counter performance. We are looking at a situation whereby the government gives out a payment without corresponding production. There is nothing that you have done. There is nothing that you have produced, but the government is paying you. What economic term is used to describe that economic situation? Like, for example, we talk of the grant, whether it's the unemployment grant, the child support grant, the disability grant. You have not done anything. Just for the sake that you're unemployed, the government chooses to give you money. What kind of payment is that? In economics, we call that transfer payment. Those are what we call the transfer payments. Right. That is the first one. Then number 132, it says the average interest rate that commercial bank charge their best customers. We are looking at commercial banks versus their best or their favorite customers, not any other ordinary customers. The special customers to commercial banks are given a special treatment. They are charged a specific rate which is slightly different from ordinary customers' rates when you borrow money from the financial institutions. That one we call it the average interest rate that commercial banks charge their best customers. In this instance, we are saying is our repo rates. Then the next question is saying the general reduction in the prices of products. A general reduction in the prices of products. If the prices are not going up and they are going down, that's a situation of a deflation. Then when the process of transforming ownership from the public sector to the private sector, we are transforming ownership from public to private. That transition from state-owned enterprises to public, from state-owned enterprises, which are parastatals, to privately owned enterprises, we will be privatizing. And the opposite, if you are turning businesses from private to public ownership, that is called nationalization. Right. The set of accounts that record the flow of currency between a country and the rest of the world. The accounts that are used to record the flow of currency between a country and the rest of the world, those are the balance of payment accounts. We call this the balance of payments. Right. The central bank allows the currency of a country to fluctuate in value according to the demand and supply for this currency. Right. We are looking at an exchange rate regime in which a country's currency is allowed to fluctuate in value according to demand and supply. We rely on the mechanism of demand and supply to determine the exchange rate of a currency against other currencies. That is what we call a free floating exchange rate. It's a free floating exchange rate. Right, we allow the market forces to determine the value of a currency. We will adopt a freely floating exchange rate, which is the opposite of a fixed exchange rate where the government decides on the value of their currency against other currencies. Or also the other regime is the managed float, where we set the upper limit and the lower limit of the value of the currency relative to other countries, and we allow the country's currency to fluctuate within the given limits of the upper limit and the lower limit. Right, that takes us to the end of question number 1.3 and also the end of section A. We now have to move on to section B. Right, name two leakages found in the circular flow. Right, when you're looking at leakages in the circular flow, I will try to make an illustration there so that when we get another question, we will also be familiar with what we call leakages. Right, when you're looking at leakages in the circular flow, we are on question 2.11. We have what we call leakages and also we have what we call injections into the circular flow. So under leakages, we are looking at money going out of the economy. If something is leaking, it's getting out. And injecting, if we are injecting something, we are bringing it in. So we are looking at money going out of the economy for leakages and money getting into the economy for injections. So we have specific items. The items that we have S, T, and M. These are our leakages and injections. We have I, G, and X. So our S is for savings. Our T is for taxation. And our M is for imports. So these activities, they are responsible for reducing the amount of money in circulation. How do they reduce? If you save money, you are not spending it. Money that remains in circulation is money that is exchanging hands. So if you decide to withdraw money and save it, it means you have withdrawn the money from circulation. If you keep your savings with a financial institution, that money is saved, is withdrawn from circulation, is no longer exchanging hands. Then number 2 is taxation. When the government taxes you, they are reducing the level of disposable income, which is the actual amount of money that you are able to spend on goods and services, which means that money which has been taxed has been taken out of circulation, has been withdrawn from circulating and exchanging hands. Then when you look at importation, we are saying money that has been spent on imports is money that has gone out of the country's economic circulation. It's money which has been spent on other economies. When we import goods, we pay for the goods in a foreign country. And in that dimension, we are saying we are reducing the amount of money circulating in our own economy, while we are paying for the exports. But however, on the extreme side, these leakages, they will have a compensatory effect on the other side of injections. Each and every leakage will come back as an injection into the circular flow. With our savings, they are going to come back as investment, which is our I. Investment, we are saying businesses, they do investment expenditure. Where do they get the money? They get the money from financial institutions. And the same financial institutions are the ones that keep our savings. If you want to gain interest on savings, we keep the money in the financial institutions. And those same financial institutions are going to lend out that money to potential borrowers, which are businesses who want to do investment. So that money automatically will find its way back into the economy, into circulation through investment funds. Then we have our taxation. It compensates with government spending, which is our G, government expenditure. Right, if government taxes money, maybe it's income tax, it's corporate tax, it's indirect tax, that money goes to the treasury and is going to be spent again on government projects and also on transfer payments. If the government is issuing out the grants, that grant money comes from tax money. So the same money that was withdrawn through taxation is going to find its way back into circulation through government spending. And we look at it from the side of importation. If we import goods, we are paying other economies, but at the same time, if those economies are buying from us, they are returning back our money. So when we are exporting, we are selling to other countries, it means the money that has been going out through importation is now coming back by us selling to other countries, where and them are paying to us as exports. So that's basically the picture of leakages and injections in a circular flow. So for the sake of our question required us to find leakages. So our leakages are savings and imports and taxes. Those are our leakages. Right, the next question is to say, why should business cycles not exist in planned economies? Why should business cycles not exist? We are saying if we have a planned economy, we are less likely to have business cycles. Why? The main reason there are no forces of demand and supply in play. There are no forces of demand and supply that affect the economy. Everything is planned. In a planned economy, it's the government's decision to decide on production and pricing. There is no interaction of forces of demand and supply. What causes the fluctuations is the changes in the market forces. At one point, supply increases. At the other point, supply decreases, demand increases. So those forces, they are going to cause a distortion in the working of the market. And hence, you are going to have fluctuations, which come as business cycles. But in the instance of a planned economy, there are no forces which are going to affect the economy. Or we can say the state controls everything. Meaning to say production is planned by the state, and also the pricing is decided by the state, and also the allocation of the resources, which means there will not be any fluctuations if the state is in charge in a planned economy. Right, that was question number 2.1.2. We move on to question 2.2. Question 2.2 is giving us the Laffer curve, which is basically showing us the relationship between tax revenue and the tax rate. Right. Identify the curve used in the graph. I think I've already mentioned that. This curve is called the Laffer curve. Right. Let me interpret the Laffer curve for the sake of understanding and for the sake of maybe clarity. This graph here is a graph which basically shows us the relationship between the tax rate and the tax revenue. The suggestion is at point A, if the government does not charge any tax, it also means it is not going to get any tax revenue. Zero tax rate is also going to give the government no tax revenue. And if you go to point B, we can see that if the government now is charging a tax rate equal to this point here, it is going to get this amount of revenue. So it means now the government is charging something, charging a percentage of tax rate, is now gaining some specific tax revenue. Then at point T, we call it the point of maximum tax revenue. This is the tax percentage that the government is charging T, and along the curve we are at point E. At point E, we can see that the government raises this much revenue here, which is the maximum amount of revenue that the government can raise. And above point E, if we try to charge at point C, you see the tax percentage is increasing. It's almost close to 70 to 100. Let's say this was 25, and this is 50, and then this is 75. For the sake of clarity, then we get our 100. It means, for the sake, let's say the government is raising 1 billion for the sake of clarity, and this is 1,500 billion tax revenue. It means at 25%, the government is able to raise 1 billion tax revenue. And if they increase the tax percentage to 50%, they are going to get maybe 1,500. But if they keep on increasing the tax revenue to 75%, they are now getting less, back to 1,000. Why? Point C has got a very high tax rate. It's now a disincentive. It's now a disincentive to work. There's no one who can work at a tax rate of 75%. 3/4 of what you have worked for is taken by the government through taxation. So there's no incentive for work there. Better not to work. But if it's reasonable, then it also means more tax is going to be raised. And also, the higher the government charges a tax, the more people try to avoid paying taxes. They will find ways of evading paying taxes. And hence, the government will lose more revenue through charging a very high rate of taxation. Right. So let's look at our questions. Name one source of income for the government. One source of income for the government. Obviously, we are talking about taxes. That's the most prominent source of government revenue. The taxes. Government gets much of its money from the taxes. And also we can talk of income, administrative income. The government charges an admin fee and other small fees that they can also use to raise money. And also the government gets money from its parastatals, though most of them, they make losses. The state-owned businesses, they're also responsible for contributing money to the government. And also you can look at leasing government properties. The government can lease its own properties like buildings to private businesses, and those private businesses are supposed to pay for the usage of those properties. So those are some of the ways that the government can get its money. Right. Briefly describe the medium-term expenditure framework, the MTEF. The medium-term expenditure framework, we can say it's a 3-year spending plan for the government. It's a 3-year planning spending plan. It's about expenditure in the next 3 years. For a government. Right. Ultimately, we are saying the government plans for the next 3 years to see how much it is going to spend. And also it helps like the government to balance competing policy priorities. Where must we spend much of our money in the next 3 years? And hence we are able to adjust the national budget for a specific year. And in that instance, we are also able to address budget constraints. So the medium-term expenditure framework is basically an expenditure plan for the next 3 years, which is done by the government. Right, we move on to the next question. Examine indirect taxes as a form of income for the government. When we are looking at indirect taxes in this instance, we are saying we have those forms of indirect taxes like the value-added tax or the sin taxes. These are taxes which are charged and which are charged indirectly, not directly to the person. They are paid through an agent to the taxpayer and not directly to the tax authority. We understand that the tax authority for South Africa is the South African Revenue Services. If you are paying direct tax, it means you have to pay directly to the tax authority. Like, for example, income tax. Income tax goes directly to South African Revenue Services. But when you're looking at taxes on consumption, for example, value-added tax, or when you're looking at sin taxes on tobacco and alcohol, they go through the medium, which is the business. And hence, the business is the one who is supposed to pay to the tax authority. You as a consumer, you are the one paying the tax, but you are not giving it directly to the tax authority. You are giving it to the medium, who is a business, and the business is going to transfer the payment to the tax authority. So we can say they are excise tax or sin, excise tax, or can look at sin tax, or we can also highlight sugar tax, we can also talk about service tax. These are some of the examples. But the issue of direct is the issue of a third party. There is a third party between the taxpayer and the tax authority. There is someone who plays an intermediary role between the two. Right. How are socio-economic rights embedded in the budget of South African government? Socio-economic rights. Right, socio-economic rights. If you look at our national budgets, it addresses Issues to do with poverty. Issues to do with unemployment. And issues to do with inequality. Those issues are addressed in the budget. Issues to do with inequality, the government tries to find ways of addressing that through the budget. Issues to do with poverty, the government tries to allocate some funds to social welfare to address the issues of poverty, tries to allocate some funds to the welfare department to cater for problems of unemployment, problems of inequality and access to resources and access to basic facilities. The government sets aside funds to try and cater for such. Those are some of the socio-economic rights which are addressed in the national budget. And also you look at social development programs. The budget has also a provision on social development. For example, building schools. And also catering for vulnerable groups of people. Those who are vulnerable or those who are marginalized, they are taken care of through the national budget. And also other issues like the grants, allocating social grants, including the child support grant. And also you can look at disability grants. Those are some of the measures to try and alleviate poverty amongst the society. We'll also look at other issues like public education. They are addressed in the budget. Those are socio-economic issues. Infrastructure development. The government initiates some big projects to develop infrastructure. So that we have to take care of mainly the disadvantaged areas. So some of these issues, they address the problem of socioeconomics. We are looking at the society and their capacity to fend for themselves. What must be done in the national budget? We address issues to do with poverty. What measures can be implemented by the government through the budget to alleviate poverty? That is where we talk about the government reviewing the amount of funds that are paid to the vulnerable as the grants, either child support, either disability, either the old age grants. We are trying to find ways of alleviating poverty amongst the vulnerable members of society. The unemployed, they're also taken care of. The government sets aside funds to assist the unemployed, either through the expanded public works programs to try and support those who don't have skills so that they can upgrade their skills at the same time getting an income. Or we can look at the government trying to put in place measures to assist the unemployed through the unemployment grant. Or we can look at issues of inequality. The government tries to address the issue of inequality through public provision. For example, providing free health care, providing free basic education. Those are some of the initiatives. They are funded through the budget. Right, that was question number 2.2.5. We move on to the next question, which is 2.3. 2.3 talks about the balance of payment. Right. Identify the institution responsible for compiling the balance of payment in the extract above. We understand that our balance of payment extract, we take them from the South African Reserve Bank, SARB. Name one product where South Africa has an absolute advantage in international trade. Where South Africa has an absolute advantage in international trade. Right, South Africa has got an absolute advantage in platinum. It also has an advantage in gold, and it also has an advantage in diamonds. Those are areas where South Africa is good and has an advantage over other countries. It has plenty of those resources compared to other countries. It can produce those resources and have them at their disposal. Briefly describe the term foreign direct investment, FDI. When we are looking at foreign direct investment, we are looking at investment from outside. This is when foreign investors invest their money in the South African economy, which results in an inflow of capital into the country. So foreign direct investment, we are saying these are not South African investors, but they are investors from other countries who are opting to come and do business in South Africa. So which means they are bringing in capital into the country. They are bringing foreign investments. They are bringing foreign capital into the country, which gives us a positive flow of capital. A positive flow of capital, there is money coming in into the economy from other economies. Explain the concept of surplus in the balance of payment account. When we are talking of a surplus in the balance of payment account, we are saying we have currency inflow which is greater than the currency outflow, total currency outflow. For us to have a surplus, it's a positive balance. It means the amount of money which is incoming is more than the amount of money which is outgoing, and we have a surplus on the balance of payment account. Money which is getting into the economy is more, and money which is leaving the economy is less, such that we have a positive balance. Right. Why are foreign direct investments recorded as a liability? Why are foreign direct investments recorded as a liability? It is a liability because this investment will have to be paid back. We have to be paid back. In the first instance, we are saying money is flowing into the economy. Is flowing into the economy, but why do we record it as the liability? It means automatically that money again is going to be paid back, because for the sake, usually the investors, they will reap back their profits into their countries of origin, and hence it means it's a liability on our economy. It's a benefit in the first instance that money is flowing into the economy, but however, we record it as a liability in the sense that the investment will have to be paid back. In the event of borrowed capital, it means that capital will have to be paid back to the country of origin. Someone has borrowed money from a foreign country to come and invest in the country. Automatically, in the first instance, that money is flowing in, but at the end of the day, the initial investment has to be paid back to where it originated from. Right. Then number 2.4, discuss the relationship between consumers and government. That one is a very simple question, which I think almost every average economy understands the relationship between the business, between the consumers and the government. We are looking at ordinary people in the balance of, we're looking at households, and we're looking at the government on another side. How do they relate? Specifically in the secular flow, how do they interact? So in this instance, we are saying these are the owners of factors of production, and they sell them to the government. what is going to happen? The government's relationship in terms of the factors of production, government has to pay for the production factors, what we call factor remuneration. For example, we are saying the government is employing people to provide labor like doctors and nurses in public hospitals. The government must pay those people. That's one relationship. And then we can also look at it from the perspective of taxation. Households, they pay tax to the government. And in return for the taxes that they would have paid, what do private business, what do the consumers get from the government? They get public and merit goods. They get infrastructure. They also get, on top of that, they get transfer payments. For example, the grants. So that is how the two relate. It's a relationship that is mutually beneficial. The households, they sell their factors to the government pays back the remuneration for the factors offered by the consumers. And on another dimension, the government charges a tax and the consumers, they pay the tax to the government. In return, the government provides them with public and merit goods and also provide them with infrastructure and also provide with those kinds of transfer payments. All right, that is how we can attempt to answer that question. Right, then the next question says, examine the relationship between unemployment and inflation. Right, I'll use space number 2.5. Right, we are looking at inflation and unemployment. Right, how do these two relate? We understand that it is the objective of the government to try and find ways of reducing unemployment. At the same time, the government also wants to cure inflation in an economy. But the relationship that is there, these two items have got what we call an inverse relationship. Right. I'll explain what I'm relating, what I'm trying to figure out when I'm saying these two have got an inverse relationship. They are inversely related. So by them having an inverse relationship, we are saying as one increases, the other one decreases, and as the other one decreases, the other one increases. This is best explained by what we call the Phillips curve. I'll try to make an illustration to show how those two relate and why do they relate in that essence. Right, we have a graph that we call the Phillips curve in economics, which is a graph which basically describes the relationship between those two variables. It's called a Phillips curve. Right, the Phillips curve is basically a graph that shows the relationship between unemployment and inflation. Right, we have our unemployment there as a percentage, the rate of unemployment, and also we have our inflation rate as a percentage also. Our Phillips curve looks like something like that. Right. So the implication is if unemployment is high, the level of inflation will be low. For example, at point A, we have high unemployment and there is low inflation. If we continue to go down with unemployment, we come to point B. We find that our unemployment is lower, but our inflation is now higher. So it's high, it's low, and it's low, and it's high. So what is the essence? We are looking at the relationship here is inverse because policies that cure unemployment are inflationary. And also, policies that cure inflation cause unemployment. So what does the government do in this instance? The government has to consider a trade-off between the two. It is the duty of the government now to decide how much unemployment must we keep for us to keep our inflation at a specific level. Or if we want to reduce our inflation, how much must we trade it off for an increase in unemployment? So it is now the duty of the government to decide. What am I saying? Let's look at policies which are used to cure inflation. Right, when we want to cure inflation, we can use monetary policies, or we can use fiscal policy measures. Right, I'll just highlight on one monetary policy instrument, and I'll also maybe highlight on the fiscal policy, how it cures inflation and at the same time causing unemployment. Let's look at, for example, regulating money supply growth. The government wants to cure inflation. There is inflation in the country and we want to cure inflation by regulating the amount of money supply growth. We reduce the amount of money in circulation, or we reduce the money supply growth. If we reduce money supply growth, it means there's less money circulating and the level of aggregate demand is going to fall. We are curing inflation because we want to reduce the amount of money in circulation by regulating the amount of money supply growth, or we can talk of interest rates. What do we do to interest rates? We have a problem of inflation. We raise interest rates to discourage borrowing and reduce the amount of money in circulation. But the moment we reduce the amount of money in circulation, it also means the level of aggregate demand is going to fall. And if aggregate demand falls, it means the businesses are now facing a challenge because consumer disposable income is now low, and hence, as a result, the government, the businesses, they retrench some of the workforce. Now we have a problem of unemployment. Because there's now reduced demand for the goods and services, the businesses are reducing productivity, and at the same time, labor costs will be high for them. And for them to cut on the labor costs, they retrench some of the workforce. Now they are creating unemployment. If you go to fiscal policy, let's say our problem here is unemployment. We are targeting to cure unemployment through fiscal policy. What must we do? In the economy, we increase government spending to create more jobs for the people. Maybe we do big projects like dam construction and major road and rail construction so that we create jobs for the people. We want to increase government spending. Right. And also we reduce taxation. These are fiscal measures to cure unemployment. We increase government spending, and also we reduce our taxation. But at the same time, the more we increase government spending, it means there's more money in circulation. If this money is not matched with a corresponding level of increased productivity, remember the amount of money in circulation, the value of money in circulation must correspond to the level of productivity in the economy. If there is no matching increase in productivity to cater for the increase in the amount of money in circulation, it is going to give pressure on the economy and prices are going to rise. There is going to be more money compared to the amount of goods and services which it must buy. And as a result, the prices are going to go high. Right, that's basically how you can describe the relationship between the two economic problems of inflation and also of unemployment. Right, that takes us to the end of question number 2. We move on to question number 3. Question number 3, it says, the first question says, name any 2 policies used to achieve the economic growth. When we want to achieve economic growth, we adopt number 1, monetary policy, and number 2, we adopt a fiscal policy. Explain the impact of international trade on mass production. It has a positive impact. Why? International trade allows for new global markets. If you have new global markets, it means it facilitates mass production, because now we are guaranteed that there is a market for the products. So more products are going to be produced because of the access to the international market of the new global markets. Right, number 3.2 says start the graph on the multiplier. Right, that is our income equal to expenditure line, which is our 45-degree line here, which is a broken line. And we also have our AE, aggregate expenditure, is equal to 10 plus 0.5 of income. This is our first graph. And our autonomous expenditure is at 10 billion. And also our autonomous expenditure for the second one is at 20 billion, which is our curve average expenditure number 1 is equal to 20 plus 0.5 of income. Right. So our equilibrium at the first consumption line is at 40 billion. Then our equilibrium at the second consumption line is at 80 billion, as we can see on our horizontal axis here. Right. Our question is saying, identify the line of equilibrium from the graph above. Our equilibrium line is the 45-degree line, this one. Equilibrium where income is equal to expenditure. So our Y is equal to E. That is our line of equilibrium, which is our 45-degree line. Right. Name one of the participants in the graph. The participants that we have in the graph, we have the consumers and the firms, or the businesses. So it's consumers for households or also firms for businesses. Briefly describe the term multiplier effect. Multiplier effect. Right, we're not talking about multiplier, we are looking at the change which is brought by expenditure. A change in spending causes a more than proportionate change in aggregate demand. A change in spending causes a more than proportionate in the total income. We are saying if there's a change in expenditure, that change is going to cause an effect which is multiplied, which is more than proportionate. A change in expenditure of 5,000 can result in a total change in the total level of income of 15,000. The 5 has been multiplied. Why? Because one individual's expenditure becomes the next person's income. That income is going to grow as it changes hands in circulation. So an initial spending, you spend 2,000. That 2,000 does not remain 2,000 because it's going to be magnified. It is your expenditure, it becomes someone's income. As it becomes someone's income, it also becomes someone's expenditure, and it becomes someone's income as it changes hands. And the process of change of hands results in production. And if we accumulate the production that would have taken place, we would be having higher income because of the money changing hands. That is basically the multiplier effect. Examine the concept of autonomous consumption. I think we have earlier on talked about that. Autonomous expenditure, we are looking at spending that consumers do, spending by consumers when they have no disposable income. Like what we are seeing on our graph, our income is 0, but our curve is starting at 10, which means this is autonomous expenditure. And also here is our autonomous expenditure. Calculate the multiplier, use the formula K is equal to 1 over 1 minus MPC. Right, that is our formula for the multiplier, and I also illustrate the other formula. Right, we want to calculate the multiplier for the given graph there. Right, our multiplier there, we are saying is 1 over 1 minus the marginal propensity to consume. So what is your marginal propensity to consume? Our marginal propensity to consume is 0.5. which means the portion of income which is consumed, because remember, money is a function of consumption and savings. The consumption pattern is such that there is a high level of consumption of 3/4 of the amount of money. So which means out of every 1 rand that a consumer gets in this economy, the 75 cents goes to consumption, and hence they can only save the remaining 25%. So this fraction of income, 0.5, is our marginal propensity to consume. Or we can also look at the marginal propensity to save. I will use the two formulas to illustrate how we come out to the same conclusion. We can use the formula K is equal to 1 over MPS. Or we can use this one here. Let's use the one which we are asked to use for the sake of the exam. Right, 1 over 1 minus MPC, we are saying our K is equal to 1 over 1 minus 0.75, which is our K is equal to 1 over 0.25, and our K is equal to 4. That is our multiplier. In this instance is equal to 4. Or we can use 1 over 1 minus MPS. Right, we are saying MPS plus MPC is equal to 1. So our MPC is 0.75. So it's x plus 0.75, and non-x plus 0.75 is equal to 1. What is our x? Our x is equal to 1 minus 0.75, which gives us our x is equal to 0.25. So for that sake, we are saying our formula is K is equal to 1 divided by 0.25, which is also going to give us 4. So that is also how we can calculate. If there was no specific formula, we can use the formula for marginal propensity to save, or we can use the marginal propensity to consume, given that MPS plus MPC is equal to 1. Why are we saying so? The amount that you save plus the amount of money that, the fraction of money that you save out of your total income plus the fraction that you are going to consume, they will give you your total income, which is equal to 1. Right, that takes us to the end of question 3.2. We move on to question 3.3. Start the cartoon below and answer the questions that follow. We are looking at the cartoon which talks about a rate cut in the economy, and just say the word governor. Right, it's going to spark it there, and the rate cut is going to be spiraled, and the economy is moving very slowly as a snail. Identify the monetary policy instrument implemented in the cartoon. If we can see there, it talks about the rate cut. The rate which is being referred there is the interest rate. So our monetary instrument policy there is the interest rate cut. They are looking at cuts in the rates of interest. Name the institution responsible for monetary policy. Monetary policy is implemented and enacted by the South African Reserve Bank. Describe the term business cycles. That one is a common, is periods of fluctuations. fluctuations in the economy. Where the economy fluctuates, that is a business cycle, or change in increasing and decreasing economic activity. Economic activity increases and decreases at specific points in time, that is a business cycle. What fiscal policy instruments are available for governments to control business cycles? I think we have mentioned that. The two main instruments of fiscal policy are government spending and number two is taxation. Those are the only two instruments that can be changed to achieve the desired goal of fiscal policy. We can manipulate those two to come out with a desired goal. Explain how monetary policy instruments should be implemented when the business cycle is entering a boom phase. We are looking at a situation whereby the government is entering a boom phase. What must we do in terms of the use of monetary policy instruments? Right. The monetary policy instruments, what you need to note here is for you to know the monetary policy instruments. Right. You can look at policies like the interest rate, and then you can also look at open market transactions or open market operations. And then also you can look at the reserve requirement. And also you can also look at moral persuasion. I'll briefly explain how we can use those instruments. Those are some of the basic instruments of monetary policy. Interest rates. If we are entering a boom phase, we must try to increase the interest rates to make borrowing expensive so that we reduce the level of the aggregate demand. Otherwise, we are going to have inflation in the end. So, with terms of interest rates, when we're entering a boom phase, we are supposed to increase the interest rates to discourage borrowing or to discourage borrowing for expenditure so that we dampen the level of aggregate demand. Then with open market transactions, the implication there is the government must sell securities to the public so that they deprive them of disposable income in their hands. If we sell out securities, it means we are giving them paper money and we are taking the real money from their disposal, which will mean that we are going to reduce the level of aggregate demand and hence avoid inflationary pressures on the economy. And also through using the reserve requirement. Through the reserve requirement, it must be increased on the cash reserve requirement, increase on the demand deposit of commercial banks, which means that we are removing money from the economy. The central bank must request for more money from the commercial banks so that they are left with little money to issue out. If the government increases the reserve requirement, if the central bank increases the reserve requirement, they now allow commercial banks to keep only less out of their deposits. They are allowed to keep less out of the amount deposited from their customers, and hence they are left with a little to give out to potential clients who want to borrow, and as a result, the amount of money that is in circulation is going to be reduced. Then also moral persuasion. The central bank must liaise with commercial banks to reduce their borrowing and also to limit the amount of money that they can give out so that we achieve a desired goal of reducing inflationary pressures on the economy. Right, let's look at number 3.4. Discuss the relationship between economic growth and economic development as public sector objectives. Right, when I'm looking at these two aspects here, let me use the space to find out how I can explain the relationship there. Right, we have on one side, this is question number 3.4. Economic growth and then economic development. What is economic growth? It's an increase in GDP, increase in real GDP. the real GDP increases, which means there is increased productivity in the economy. Then economic development, we are looking at improvements in the quality of life. The quality of life of people gets to improve. And in this instance, we are seeing that with economic development, we have to measure it in terms of GDP per capita. We look at the GDP per head. We divide the total GDP by the size of the population to get the GDP per capita, which is an indicator of the distribution of income in the economy. And these two are related in the sense that as the economy grows, more jobs are created. More goods are produced. And what is going to happen on the level of development? It is also going to improve. People have income because they have jobs. And also, prices go down because of increased productivity. And also, consumer choice becomes wide. Consumers are now able to choose from a variety of goods, which will help improve their quality of life. So these two are related in that sense, that economic growth has got a net effect of stimulating the level of economic development. Right, we'll take it to question number 3.5. Examine the measures available to correct the balance of payment deficit. Right, what you can do there is direct. When you want to control a deficit, we are saying we are paying more for imports and getting less from exports. So what can we do? We can do import controls. We can give examples of import controls there, like we can impose tariffs, or we can impose import quotas, so that we limit the amount of goods that enter into the country through importation. And then we can engage in export promotion to encourage local businesses to produce for the export market, so that we have higher value of exports. And the government can give incentives, incentivize exporting businesses as part of export promotion. And also, we can use borrowing and lending to correct the balance of payment deficit, though it's not a viable economic measure. We can try to borrow from the IMF to try and finance the continuous or the chronic deficit. Right. We can also manipulate the interest rates, and you can also do import substitution. I think that is most important. We can also do import substitution. We try to substitute imports which are being imported by locally produced products. We try to find perfect substitute for the imports from the domestic market, and also we try to substitute it using that way. And also, in another instance, we can also look at a change in exchange rates. If you are adopting a fixed exchange rate regime, we can manipulate the exchange rate in favor of our currency, so that it becomes cheaper to buy in our own country and not to buy from foreign countries. So basically, those are some of the measures that we can put in place, but we are not limiting ourselves only to that. There are also other measures that you can talk about. Right, that takes us to the end of question number 3. Let's move on to question number 4. Question number 4, name and 2 factors that can influence the exchange rate. Right, the exchange rate is basically determined by the supply of the currency and also the demand of the currency. And also, we can also look at it from the perspective of the level of inbound tourists. They can also affect the rate of exchange. Right. Explain the nature of a business cycle. The nature of business cycle is actually, when we're talking of the nature of the business cycle, we are looking at the expansion and contraction of production and output of goods. It's expansion and contraction of output of goods that happen over time. That's business cycles. Sometimes there's expansion, sometimes there's contraction, an upswing and a downswing. Right, let's look at those state-owned enterprises, the South African Post Office, the South African Airways, the South African Broadcasting, and the Master of Load Shedding, ESCOM. Right, it talks about parastatals by Zapiro. Identify one state or state-operated enterprise in the cartoon. We are having them here, the Post Office, the Airways, the Broadcasting, and the Master of Load Shedding, ESCOM. Name one necessity of the public sector. Why is the public sector necessary? One necessity of public sector. One of the necessities is social rights. They have to address the issue of social rights. And also, the necessity is also at the address of economic rights. And also, the basic human rights. It is the duty of the public sector to address those things. Describe the term parastatals. Parastatals basically are institutions that are wholly or partially owned by the government. They are wholly or partially owned by the government. Right, like these ones indicated here, some are wholly and some are partially owned by the government. That those are parastatals. Explain the advantages of privatizing state-owned enterprises. If you are giving them into the hands of the private sector, one most of the obvious things is efficiency. They're going to run efficiently and reducing waste. And also there's going to be competition, which is a positive. It encourages competition in the economy. And also the government is going to get tax revenue. And also the government is going to lessen its burden on the fiscus. The government is always funding these state-owned enterprises and supporting them, bailing them out of their losses. So if they are privatized, the government is also going to get a lesser burden on the fiscus in trying to support non-profitable businesses. Discuss reasons for public sector provisioning. Right, when you're looking at public sector provisioning, what is the rationale for public sector provision? Right, we look at public goods. For the supply of public goods, these public goods, because of their non-rivalry and their non-excludability, they cannot be effectively supplied by the private sector. Hence, it is the duty of the government to supply those public goods. And also, we look at the supply of merit goods, like education, which cannot be effectively supplied by the private sector. And also, we look at the provision of the community goods, jointly consumed goods. Then we also look at what is the other reason to conserve the resources. The government is there to conserve our resources and protect the environment. It is the duty of the government to conserve resources or to protect the environment. And also, if you look at it from another dimension, we can say the government is there to manage the economy. That's the other duty. Right. We look at the next question, which is question 4.3. It talks about the demand and supply of dollars and the price of dollars relative to the quantity of dollars per day. Right. The first question says, name one currency used in the graph above. We are looking at the rand on the vertical axis and the quantity of dollars in billions on the horizontal axis. So it's the rands, and we have the dollar. Identify the original exchange rate equilibrium. The original exchange rate equilibrium. Right, our original supply and our original demand are these ones. They are meeting at point E. So what is the original equilibrium exchange rate? The exchange rate is 16 rands for the equivalence of $10 at E. This is our equilibrium. So it's 16 rand for 10 US dollars. Briefly describe the term devaluation. Right. There is devaluation, which we are going to define here. And then there's depreciation. Those two are not the same. Devaluation, we are saying, is deliberate or is official. Or is official. Lowering of a currency value. Relative to another. So what you must note there is devaluation is done deliberately. It is not done out of, does not come as a result of the market forces. It is the authorities who decide to lower the value of their currency. So it's deliberate or it's official. Why did the demand for dollars per day decrease? Why did the demand for dollars per day decrease? It can be because of a decline in payments for services from USA. Decline in payments can be a reason for services from USA. Because why we demand the US dollar is because we want to do business with the USA. So if there's a decline in the business between South Africa and USA, it means the demand for the dollar is going to decrease. Or we can look at also a decrease in the number of South African tourists spending money. For example, in tourism, if there's a decrease in the number of tourists who are spending money in the USA, it means the demand for the dollar is going to fall. There is less demand for the dollar on the market because the tourists who are supposed to be going to the USA are declining. Who will demand the dollar? Right, then it says what type of interventions can be implemented to influence a free floating exchange rate? What kind of intervention can be implemented to influence a free floating exchange rates? We can look at buying or injecting dollars into the market. But the basic thing is these forces are determined by the exchange rate, determined by demand and supply of the currency. That is the most important thing. So what you can do there is we are trying to manipulate either the level of demand or the level of supply of the currency so that we can achieve a free floating rate manipulation. Those are the interventions. So what can we do? We can buy or inject dollars through the reserves from the South African Reserve Bank. They can inject money if they want to dampen the value of the dollar. They put more dollars on the market to make it cheaper and hence to make the South African rand gain against the US dollar. Or if they want to reduce the rate of the South African rand against the dollar, they buy the dollars out of the market so that there is a demand for the fewer dollars, which will result in their price going up in relative to the South African rand. So buying or injecting the dollar, or we can also look at the South African central bank can also try to affect the level of the exchange rate, but that is not very possible because the forces of demand and supply are the ones who are dominant in the market. So for that sake, to manipulate the level of the equilibrium, they can only rely on buying or injecting the dollars into the market so that they can achieve the desired result on the freely floating exchange rate. Right, interpret leading and composite indicators as features underpinning forecasting in business cycles. Right, for that reason, we do not need to waste time on the indicators. Features indicating the forecasting of business cycles. Leading, we are saying the leading indicators, they change before the actual change in the economy. The real GDP hasn't changed, but there are indicators that the economy is going to change. For example, jobs advertised. If you see more jobs being advertised, it's an indicator that the economy is more likely to go on to a boom. The economy is going to do good because there are more jobs being advertised. Right. And then we look at composite. It's a combination. It's a combination of a number of indicators which are combined together to try and predict or forecast the business cycles. We make use of a number of composite indicators, of a number of indicators. We put them together to see how they can help us in predicting the likely change onto the economy. Then it says, discuss supply reasons as reasons for international trade. What is on the supply side that facilitates international trade? We can look at natural resources. For the reason that natural resources are unevenly distributed, for example, minerals. There are some countries which are rich in a variety of minerals and some countries don't even have one. So for that reason, we tend to trade with other countries who have got no such resources. And we also have reasons for climatic reasons. Climatic conditions allow for production of different products. For example, in agriculture, some climatic conditions favor the production of some specific products, while some do not support. And hence, for that reason, we need to trade with other sections that do not have the supply of the same resources. And also, we can look at labor resources. Our labor is heterogeneous, which means labor is not actually the same. Some people are skilled in doing a particular task, and hence they can be effective in producing a specific product. And hence it facilitates the need to trade with areas where people cannot be able to produce such products. And also we look at technological resources. Here's another reason. Technology, it is allowed for production of specific goods to take place at a lower cost. For some, we can be able to develop. And for some, they cannot have access to technology, and hence there is need for those who can produce at a lower cost to trade with those who have no access to technology. Then you can also look at it from the perspective of specialization. Countries are now specializing, which means we cannot be specialists of all forms of production. And as a result, we can only focus on the production of goods and services in which we are best at. And hence, at the end, we are now able to trade our products from our area of specialization to areas that we do not specialize in. All right, that takes us to the end of question number 4.5 and also the end of section B. We quickly move on to our last section, which is a section on essay questions. Right. Our first question, question number 5, it says, discuss in detail the markets within the four-sector model and then interpret the purpose of the system of national accounts as outlined by the United Nations. Right, we're going to do our question number 4, the four-sector model. Right. This is question number 5. It talks about the four-sector model. We want to discuss in detail the markets. Right, when we're looking at our markets, we do not need to waste time. Our markets, we have number 1, we have a goods market, or we have our product market. Then number 2, on our markets, we have our factor, or what we call the resource market. And then number 3, we have our financial markets. And our financial market is divided into 2. It's divided into money and into capital. And then lastly, in a four-sector model, we have the foreign exchange. Market. Right, those are our markets. Once you are able to identify your markets, it does not take much effort to discuss those markets because you know them. We are looking at the goods or product market. We are looking at a market for the final goods and services. And when we are looking at these final goods and services, we are looking at the consumer goods and their classification. You classify consumer goods into non-durable. You can classify them into durable. You classify them also into semi-durable. And also you classify them into services. Right, so when you're looking at non-durable, when you're looking at durability, we are looking at time in use. Non-durable, these are goods which are meant to immediately satisfy the needs and wants. For example, food. These are typical goods that you see there on that market. Durable goods, those are long-lasting goods. For example, cars. And semi-durable, for example, clothes, they last relatively longer. And services, you can look at maybe healthcare. Those are typical goods that you find or products that you find on the product market. You can also talk of capital goods, but though you can talk of them in detail as a part of the resource market. Then when you go to your resource market, you know this is a market for factors of production. What are the factors of production? This is where land is sold. When you are explaining, you are now giving us the factors of production. You talk about labor. You talk about entrepreneurships. You talk about capital. Those are our factors which are traded in the resource market. For land, it's traded for the rent. And for labor, it's traded for wages and salaries and also commission. For entrepreneurship, it's traded for profit. And then capital is traded for interest. That is what happens in the factor market or the resource market. Then you go to market to the financial market. This is not directly involved in production. If you can explain, the financial market is not directly involved in production and distribution, but it facilitates with the savings and the availability of capital for investment. We can go and deposit our money for saving purposes, while its businesses can go and borrow money for sake of investment. So we have a money market. This is a market for short-term finances. And the SARBs is the major player. Then we have a capital market, is a market for long-term financing. And we have the Johannesburg Stock Exchange as the major player in the capital market. Right. Then we have the foreign exchange market. This is a market for currencies of different economies. You look at the usage of the exchange rate as the determinant of the value. The value of the currencies. And also you can look at the regime of the exchange rate. In some markets, they use the freely floating exchange rate, where demand and supply determines the value of the different currencies. Right, that's basically the picture of the markets. You explain along those lines. That is how you get to address the issue of the markets in the four-sector model. And there's nothing more that you can talk about besides elaborating on those aspects that we have just indicated. Then we look at our second question, our additional part. It talks about the system of national accounts. Interpret the purpose of system of national accounts. That is our question. The system of national accounts adopted by the United Nations. Right. We're looking at the system of national accounts, which we can say the system of national accounts. What is the purpose, or why did the UN adopt a system of national accounts? Right, basically that is a set of international guidelines for the development of economic accounts. Right, and also for the reporting of statistics, we must adopt a unified or a standardized way of reporting our national statistics. For one reason or the other, it provides a comprehensive framework. It gives us a comprehensive framework for organizing economic data. What it means there is we have a set of standards that we must follow if we are to organize economic data, because they are already set by the UN. We are supposed to follow that set, which is part of the system of national accounts, which means for every country, we now have a guideline, or we have a framework that we must follow, which is comprehensive, which guides us on how to organize our economic data, such that not every country uses its own system, but we follow a prescribed way or a prescribed framework for organizing economic data for all the economies. And that is a standardized way for that sake. And for the sake, it also allows for comparison of economic data or economic performance. It allows for economic performance to be compared for different countries or for different economies. Right. It's possible because we are using a standardized method of gathering the data and presenting it. So for that sake, we have a standardized way, which makes it feasible for us to do the comparison of the performance of the different economies, because we have a set of guidelines that we are following, which are standardized. And also we can say it's a tool for policymakers. It's a tool for policymakers in every economy. How can they use this tool to assess the impact of their decisions on the economy? the impact of their decisions on the economy. It's also another benefit or another rationale for the system of national accounts. We are also able to figure out, for policymakers, they will be accountable and they will be able also to assess how they designed their economy in relation to their performance of the economy, what they did and how it impacted on the economy. They can assess it through the use of the standard of national accounts. And also helps to understand the structure of the economy. The structure of the economy. Right. We can be able now to figure out the production, the income, the consumption, and also the accumulation of wealth in the economy. And we can be able now to make informed decisions about those different sectors. And also we are able now to figure out the contributions from different sectors of the economy. Be used through the use of the system of national accounts. Or we can also say the national account system is there to monitor the economic trends. It helps to monitor economic trends. We can monitor economic trends such as GDP, growth or inflation. We can be able to figure out and monitor those variables in the economy. Or issues of unemployment, we can also be able to figure them out and be able to trace them as we follow the trend of the system of national accounts. Right, that was question number 5, the additional part. Right, let's look at question number 6. Question number 6, discuss in detail reasons for public sector failure, and then critically evaluate the impact of an increase in the basket of food items exempted for value-added tax on the economy. Right, so we're going to do the main part first, the reasons for public sector failure. We are saying, when we're looking at public sector failure, we are saying the government is failing to provide what it is supposed to provide. The government is failing to deliver what it's supposed to deliver. What could be the reasons? This is question number 6. If the government is inefficient, what could be the reason that the government fails to deliver what it's supposed to deliver? If we see poor public service delivery, what are the reasons? Those are the reasons for public sector failure. Right, number 1 that we can talk about when we look at public sector failure, we look at issues of management failure. Right, when we are addressing this issue of management failure, we are saying the politicians who are our leaders in government, they promote policies and continue to spend money on projects as long as they can get votes on them. So they prioritize votes at the expense of the economy. As long as they are going to get support from the public, they might implement policies which they see that they are failing, and they will keep on spending money on such priorities which will give them a vote at the expense of delivering the full services that they are supposed to be delivering, or at the expense of improving the welfare of the people. That is management failure. And also we can look at it from the perspective of apathy. When we are looking at apathy, we are saying the officials, they have less interest. Right, government workers are demotivated. They do not have motivation. They lack interest in what they do. So they work for the sake of getting to get paid, not for the sake of having delivery at their core and at their hearts. They do not work with the people at heart. They work for the sake of getting work to get paid. They do work out of, like there's no commitment for them to do work. And at the end of the day, they are always inefficient in whatever they're doing, or always they deliver poorly because they lack motivation or interest in their jobs. Right. And also we look at other reasons. We also look at bureaucracy. When we look at bureaucracy, we are looking at the long chain of command. And as a result, service delivery is delayed. The government takes long to take action, even on urgent issues, because the chain of command is very high. There are lots of people to be consulted through the process. So there is an official process to be followed, which is very long. And hence, it takes long for the government to take action, and hence it ends up failing to deliver where they need to deliver in as quick as is possible. Then we also look at the politicians. They're also another reason for the failure of the public sector. People who are politicians, they aim to be re-elected. And have short-term horizon. A person who has got a short-term horizon does not focus on the long term. What they are focusing for is to get into office, they perform the immediate duties so that they keep their position and they get to be re-elected into office. They cannot engage themselves in long-term projects, like engaging themselves in a 10-year projects or 15-year projects. What they only want is to do something which is immediate so that they will gain the vote, and they will promise people that they will do more with time once they are re-elected. So the cycle continues, and they keep on failing to provide long-term needs of the people, but rather will satisfy immediate needs of the people to secure their vote. And at the end of the day, the government fails as a whole. Right. And also we look at it from special interest groups. These special interest groups, they can also contribute to government failure for the sake that, for example, organized labor or the trade unions, they can have stronger influence on the government, and they can manipulate the government to their own advantage. Why? Because of their power, they are strong, and hence they can influence the government decisions. And hence the government will take action based on the influence that it has been given by these special groups, and also not because of the sake of attaining the main goals that the government is supposed to be addressing. And also can look at structural weaknesses. The government can also fail because of instances of structural weaknesses. E.g., some objectives may work against each other. Objectives working against each other. It can result in a failure if we are having competing alternatives. We have competing objectives in that sense. That is going to give a special complication. For example, we are looking at things like during the COVID time, we looked at the issues that were put in place, the rules to combat COVID-19 effects. They ultimately reduced the functionality of the economy. We are putting restrictive measures. At the end, the economy is failing to perform. Why? Because we want to prevent this problem. We are addressing health issues. At the same time, we are compromising the performance of the economy. We are restricting the number of workers in the workplace. At the same time, we are reducing productivity and affecting the level of GDP. So sometimes we have objectives which are contrasting each other, or which are working against, or which are competing. That is a structural weakness. And at the end of the day, the performance of the state is compromised. Right. And also we need to look at it from the perspective of the additional question. Right, our additional part is talking about the impact of an increase in the basket of food items which are exempted from value-added tax on the economy. If we are having an increase in the basket of food items which are exempted from value-added tax, what is the impact? Right. We are saying more and more commodities from the basket, they are being now tax exempt, which means they are no longer part of the products for which value-added tax is charged. What is the implication if you are having some of the products that we have in the main basket, and in that main basket we are seeing that some of the products, they are exempted from value-added tax, meaning to say they are no longer liable for the payment of value-added tax. We understand value-added tax has got a net effect of affecting the final price of a commodity. And for that sake, it is not the business which is liable to pay the increase in the cost, but it is the consumer, because the business will shift the burden of expenditure from its side to the consumers by just increasing the prices of the products. Right. So what happens if the government is exempting some other products from the basket? What is going to happen? What is the implication there? Right. So this is our additional part for number 6. Right. The implication there is it has the effect of provision of relief. Relief to poor South Africans. It provided relief. Why? Because if products are exempted from tax, it means their price is going to go down. The additional cost, which is part of the tax, is now having to be reduced because those products are no longer paying value-added tax. And also, what is the net effect? If you are looking at the basket of products, you are looking at the basic commodities which are required for a particular day-to-day life. And for that sake, we are looking at it had potentially added protein and addressed the problem of malnutrition. The problem of malnutrition had been addressed because of the decline in the prices of the products in the basket as a result of them being made to become part of the tax-exempt products. So potentially we are saying it has added protein to the diet of the ordinary South Africans, and also it had contributed towards the reduction of the common problem of malnutrition in the South African society. Right. We can also look at the implication here. If we look at value-added tax, it is inherently regressive tax without a zero-rated items, as the paid amount paid by lower income households as a share of disposable income is higher than the richer household. Right. So our value-added tax is inherently regressive. What are we saying here? If you are saying our value-added tax is inherently regressive without zero-rated and without any zero-rated items, what we are saying here, the idea is if we don't have any zero-rated item in the basket, we don't have any product which is exempt from the income tax. It also implies that it becomes regressive in the sense that much of the food which is part of the basket is consumed by an average family in South Africa. most dominantly an average and a below average family, which means in this instance, if there are no zero rated items in the basket, it means the poor are the ones who are paying more of value added tax, while the rich are paying very little. Why? Because they consume less from the basket, and also their income is relatively higher compared to the amount of money that they are paying for the products which are supposed to be paying the tax. So if there was no zero rated products in the basket, automatically it means that the system was going to be a regressive system, which is to the detriment of the poor people in South Africa, and which is going to be an unfair practice on the side of the poor. They are going to pay more compared to the higher income earners. Right. And also we look at it on the other side. The benefit to the rich is far larger as they consume larger quantities of zero rated goods. Despite this, however, the impact or the benefit to the rich is more. We are saying it has benefited the poor South Africans, but however, the benefit is more to the rich. Why? Is because their expenditure is large. If we increase the amount of goods which are zero rated compared to what they were supposed to pay, it also means that they are going to benefit more compared to the poor people in the country. And also, if you look at it, South Africa's value-added tax exempt list currently includes 19 basic foods, such as brown bread, maize meal, milk, rice, vegetables, and eggs. So, as to the benefit, we are saying they are tax exempt products. We have brown bread, which are basics, is tax exempt. And also we have maize meal and milk. Our maize meal, our milk, and also we talk of other products like rice and vegetables. We talk of eggs. These are some of the products which are exempt, which are zero rated. And for the sake of these products, these are consumed on a regular basis, which is a benefit to an average South African, which is also a benefit in terms of nutrition requirements for the average people. They are now able to address issues of nutrition because these basic commodities have since stayed on the basic foods which are exempt. Right. And the other concern is that the cost of foregone revenue that is generated could encourage imports, and that the benefit would not be passed on to the consumers. The cost of foregone revenue, the revenue that we're no longer getting because we have exempted the products, it could encourage imports, and the benefits will not be passed on to consumers, which means we are saying cost of foregone that zero rated rating could encourage imports. And benefits would not be passed to the consumer. It's another concern. In other dimensions, we are saying the consumer in some instances might not benefit from the tax exempt products because the cost of foregone revenue it could be used for imports. We are now having tax-exempt products, and now we are saying the level of disposable income is high. People might decide not to buy from the local market and then decide to buy from the import market, and hence the benefit that they were supposed to reap from the reduced price is not going to be realized by the customers for whom they were supposed to be the beneficiaries of the tax-exempt issue, which was planned by the government to try and lessen the burden on their expenditure pattern and also to try and raise their level of disposable income. Right. So basically, that's the picture of what we're supposed to address. And also remember, with your essays, you are supposed to start them with a contextualized introduction where you define the key terms, and then you tie your argument at the end by a high order conclusion, giving a summation of the key aspects that you would have been discussing in your additional part or in your main part of the question. Right. So that's the picture of how our economics is going to be like in the June examinations. So it takes you an effort to prepare yourself for the examination and to prepare yourself fully so that you get the best possible marks out of the first paper. It is my belief that this discussion is going to assist you and is going to prepare you for the coming examinations. We hope we are going to meet again in other discussions, like for discussion for paper 2 and also some other theory discussions. With that being said and done, we can safely conclude that we have come to the end of this session. Thank you for watching. Your host in economics.
Welcome to Thundereduc, an online learning platform powered by professional, highly skilled and qualified educators.
We deliver structured CAPS-aligned lessons for high school subjects including mathematics, physical sciences, life sciences, geography, business studies, history, accounting, English, Afrikaans, and others.
For the intermediate and senior phases, we offer expert teaching in natural sciences, mathematics, social sciences, English, and EMS, designed to build strong academic foundations.
Access the distinction material books by clicking join button on our YouTube channel or download Thundereduc app on Google Play Store for all our study material and past exam papers.
Thundereduc offers extra classes for rewrites, old curriculum, and other students from grade 4 to grade 12 through online and physical classes.
Subscribe to our YouTube channel Thundereduc for reliable curriculum-focused learning and stay updated with the latest educational content.
Please like, share, and turn on notifications so you never miss a lesson.
Visit us at www.thundereduc.com
or call 0786 636 613 or 084 833 1738 for more details.
Thundereduc, we focus on quality.